Thank you for attending our first Finance 101, and I have to acknowledge the extended hard work of John Kelly, Kathy Doan, Brad, Scott, Mia, and Molly to pull all this together. Some simple housekeeping before we get into it. If you're in the room, please sign in if you're on a committee whose attendance is required. If you're on Zoom, and we're taking attendance on Zoom, so make sure your name is correctly spelled and clearly shows up. The video of this training will be up by the weekend, and we have to end by 6 o'clock. We have another presentation that will be live remotely at 6. So if we don't get to your questions, we'll parking lot, I'll keep track of the questions, we'll parking lot them to return to a next session or somehow acknowledge that we've got them. I will moderate and keep us moving along because there are going to be questions after each part of the presentation. And did I forget anything, Kathy?
No.
Okay.
No, thank you.
So we're going to move right along, and Kathy and her colleagues will take it away. You want this light out?
Yes, that would be great.
Great.
So Mia, anytime you're ready to start the first training video, go right ahead.
You want both out, or?
Yeah, I think
Yes?
so.
It's easier to see.
Mia,
Like most households and businesses, local governments must manage a stream of revenue and expenses.
Can everybody
to
hear
ensure
that?
that services are delivered.
They need to turn it
Mia,
up.
can you pause for 1 second, please? Could you make sure it's on a full screen and increase the volume, if possible, please? Thank you. You may continue once you're ready.
Municipal expenses vary by type and by community and include education, public safety, public works, and other costs. To budget for and fund these expenses, cities and towns rely on different revenue streams, including property taxes and local receipts, such as meal and motor vehicle excise. Municipalities also receive local aid from the state and may use their own financial reserves for these costs as well. Property taxes are the most significant revenue source for Massachusetts municipalities, as they are the primary revenue source for all cities and towns across the Commonwealth. On average, property taxes account for over 70% of local budgets. Therefore, understanding Proposition 2.5, a statewide law that governs property tax assessment, is a key part of municipal budgeting and management. Approved by Massachusetts voters in 1980, Proposition 2.5 sets limits on the amount of property tax that can be collected or levied by a city or town annually. It outlines how new growth in the tax base can be identified and sets guidelines for levy limit overrides, underrides, and exclusions. A detailed walkthrough of Proposition 2.5 can be found on DLS's Municipal Finance Training and Resource Center. Since property taxes are the primary source of revenue for Massachusetts municipalities, the assessor serves as a key member of a community's financial management team. Among their other duties, the assessor prepares and maintains an accurate property database and classifies real estate into 4 classes: residential, commercial, industrial, and open space. They also determine the valuation of property as of the January 1st assessment date, which requires knowledge of various appraisal methodologies. Once a municipality's tax rate and property valuations are approved, the assessors also prepare a tax list and warrant and commit taxes to the collector. They also grant abatements and exemptions to taxpayers who must file timely applications with the assessors and administer motor vehicle and other excise bills. The assessor works closely with the collector, as well as other members of the financial management team. As we will see, Teamwork amongst local officials is essential to effective financial management in every community. Let's look at just a few of the responsibilities of other local officials. The tax collector is responsible for billing and collecting all taxes committed by the assessor. As mentioned, the collector receives the tax commitment from the assessor, sends bills to taxpayers, and collects corresponding payments. In some communities, the collector collects not just taxes, but all accounts due to the municipality, such as water and sewer bills. Once collected, funds are turned over to the treasurer, who is the custodian of all municipal funds. The treasurer is responsible for the deposit, investment, and disbursement of municipal funds. They work with the community's financial advisor and bond counsel and supervise the debt issuance process. The treasurer also manages the tax title process once the collector has made a tax taking as the result of an unpaid bill. The accountant or auditor records all of the financial transactions of the municipality. They use this information to prepare financial reports like the balance sheet submission in Schedule A for review by the Division of Local Services. The accountant auditor also prepares interim reports for the community to consider during the fiscal year to assist in budgeting, and also notifies departments monthly of unspent and unencumbered appropriation balances. All bills for payment are approved by the accountant auditor, who monitors spending to assure that goods have been delivered and services have been rendered. These and other members of the financial management team work together with other appointed or elected officials who oversee and manage local government. But who are these other elected or appointed officials? This depends on whether the community is a city or a town. In most towns, an elected select board serves as the chief executive branch with responsibility for developing overall policy and coordinating the general operations of town government. The select board appoints certain officials in the town, whether it be in accordance with state statute, a charter provision, or local bylaw. The select board issues town meeting warrants and negotiates collective bargaining agreements for all departments, except schools, and approves vendor and payroll warrants for payment by the treasurer. The select board also prepares or reviews budget proposals for town meeting approval. These budget responsibilities are usually shared with the Finance Committee, a body that advises town meeting on financial matters. The board also plays a role in tax policy by voting to place a Proposition 2.5 override, debt exclusion, or capital outlay exclusion question on the ballot. The legislative body of a town is town meeting. As the appropriating authority of a town meeting adopts the budget and authorizes debt issuances. Town meeting also has local lawmaking authority through the enactment of bylaws. Most towns have a chief administrative officer that oversees its day-to-day operations. This person is usually referred to as the town administrator or town manager. As with other roles, the responsibilities of this individual vary by community, but will typically involve the coordination of the financial operations of the town. Other duties are likely to be assigned by the select board as needed. In a city, the mayor or city manager is the chief executive officer. The mayor or city manager has all the duties of the select board in towns, including appointing authority and oversight of administration and finances. In a city, however, this individual prepares and submits the budget to the city council, which can then only approve, reduce, or reject the mayor's budget proposal. The city council is the legislative branch in a city, and is the municipality's appropriating authority, which adopts a budget and authorizes debt. It also has lawmaking authority through the enactment of ordinances. City council plays a role in tax policy by placing Proposition 2.5 questions on the ballot with the mayor's approval. We've reviewed just some of the responsibilities of local officials who play an important role in the financial management of their communities, which requires collaboration amongst a financial management team. For more information, visit the Division of Local Services website at mass.gov/DLS. There you can find the Municipal Finance Training and Resource Center, and find more information about roles and responsibilities of local officials and best practices for municipal financial management. You can also visit DLS's YouTube page, linked on our website, for other informational videos like this one on a wide array of municipal finance topics. Thanks for watching.
Proposition 2.5 is a law enacted in 1980 by voter initiative. It went into effect for fiscal year 1982 and dramatically changed local budgeting practices because it constrains or limits
Mia?
the annual...
Okay, yeah, can you start that from the beginning again, because it was interrupted? Thank you.
Proposition 2.5 is a law enacted in 1980 by voter initiative. It went into effect for fiscal year 1982 and dramatically changed local budgeting practices because it constrains or limits the annual property tax levy. To understand how the constraint works, we must define three terms, what we refer to as the three building blocks of Proposition 2.5. 1, the tax levy, 2, the levy limit, and 3, the levy ceiling. The first building block is the property tax levy. The property tax levy is the revenue a community raises through real and personal property taxes each year when it sets its tax rate. The property tax levy is the largest source of revenue most municipalities have to fund their budgets. Therefore, any constraint on the levy has a substantial impact on a community's budget. Budgets adopted before Proposition 2.5 were often driven by departmental spending requests with limited coordination among local officials and little attention paid to other local revenue sources, such as charging fees to users of local services. The reason was that property taxes could always be levied at whatever amount was needed to balance the budget at the time the tax rate was set. Proposition 2.5 fundamentally changed this process. Now, budget decisions must be made within a specific revenue estimate. This has generally led to greater coordination and better defined budgeting that considers the current and future needs and financial goals of the community. Proposition 2.5 established two types of limits on the annual property tax levy. 1, the levy limit, and 2, the levy ceiling. The second building block is the annual levy limit. The levy limit is the key or primary limitation established by Proposition 2.5. It is the maximum dollar amount a community can routinely levy in any given fiscal year. That is, it defines the maximum amount of property tax revenue a community will ordinarily have to support its annual budget. The third building block is the annual levy ceiling. The levy ceiling is the maximum amount the levy limit may be in any given year. It is a constraint on the size of the annual levy limit. To summarize the basic concept of how Proposition 2.5 works, we start with the basic building block of the annual property tax levy. The tax levy must fit within the annual levy limitation block, and the levy limit must fit within the annual levy ceiling block. The Department of Revenue is responsible for determining the annual levy limit and ceiling for each community and ensuring the tax levy fixed by the setting of the tax rate complies with Proposition 2.5.
Thank you, Mayor. If you could pause before the next slide, please. Brad, if you could step up to the podium. Brad Highnote, our town principal assessor. If anybody has any questions, we're going to stop between each individual video so that we can address any questions on that particular video. So if are there any questions on that segment so far?
On Zoom?
Mia, anybody on Zoom raising their hand?
No hands, Kathy.
Okay, great. Please proceed to the next video.
Rapt audience.
As we said previously, the levy limit is the maximum dollar amount a community can routinely levy in any given fiscal year. The key to understanding how the levy limit is calculated is to understand that the limit is an historical figure. This simply means that the levy limit for any given fiscal year is based on the previous year's levy limit. The amount actually levied in the prior year is disregarded in the computation. The levy limit base is what the community could have levied under its levy limit, not what it actually levied. The first step in calculating the new levy limit of any year, then, is to begin with last year's levy limit. That limit is increased by two factors. The first factor is an automatic 2.5% increase in last year's levy limit. The second factor is what we refer to as new growth. To illustrate the basic levy limit calculation, let us say that last year's levy limit was $100 million. That $100 million base is first increased by 2.5%. In this case, that would be $2.5 million. Next, we add the dollar amount allowed as new growth. Let us say, for illustration purposes, that our new growth factor is $2.5 million. That gives us a subtotal, or preliminary levy limit, of $105 million. We will come back to this preliminary limit in a few minutes. We will now look at how we calculate that new growth factor.
Do you want me to keep going?
Any questions on that so far? We'll keep proceeding. None in the audience? Anybody on Zoom?
I don't see any hands.
Okay, great, Mia, thank you. You can proceed.
The new growth factor is a dollar increase in the annual levy limit that reflects additions to the community's tax base since last year. Proposition 2.5 recognizes that new development results in additional municipal costs. For example, a new subdivision increases school enrollment and new businesses increase public safety and infrastructure requirements. The law sets out this formula for calculating the annual new growth factor. The extra assessed value added to the tax base due to the new development is multiplied by the previous year's tax rate. This formula arrives at a dollar amount to be added to the levy limit as new growth. Basically, what this formula measures is how much tax revenue the new development would have generated if it had been taxed last year. The added value that is included in this calculation comes from three basic categories of development. The first and usually largest category is made up of properties that have increased in assessed valuations since last year because of development and other construction activity on the site. Most of a community's new growth comes from this category. For example, last year, Parcel A was assessed as a vacant house lot for $50,000. This year, Parcel A has a new house on it and is now assessed for $250,000, an increase of $200,000. That $200,000 in added value due to the construction activity is included in the calculation of the community's new growth factor. The new structure doesn't have to be completed. For example, Parcel B is a single-family home that was assessed for $200,000 last year. An addition was built to the house, and this year, Parcel B will be assessed for $225,000, an increase of $25,000. That $25,000 in added value due to the construction activity is also included in the calculation of the community's new growth factor. The second category of tax-based growth is made up of exempt property returned to the tax rolls and new taxable personal property. For example, last year Parcel C was owned by a private college and was exempt from taxation. The college sold the parcel to a developer, and it is returning to the tax rolls this year with an assessed valuation of $100,000. That $100,000 in added value to the community's tax base is included in the calculation of the new growth factor. The third and final category of tax-based growth is the net increase in the community's assessed valuation that results when property is subdivided or converted to condominiums and taxed as separate parcels. For example, Parcel D is a 20-acre site of vacant land that was assessed as a single parcel for $1 million last year. Since then, a subdivision plan has been approved for the site. The plan creates 10 2-acre house lots that will be assessed as 10 separate parcels this year. Under the assessor's land valuation schedule, the total valuation of the 10 lots ends up being $1,100,000, a $100,000 net increase in the assessed valuation of the community. That $100,000 in added value due to the subdivision and taxation of the land as separate parcels is included in the calculation of the community's new growth factor. The new growth factor does not include the increased assessed valuation of a community's tax base that comes from the higher market value of property. The valuation increase has to result from a change in the physical condition, taxable status, or taxable unit of a property. For example, a single-family house was valued at $300,000 last year and is valued at $350,000 this year. No construction activity took place on the site. The house is simply worth more in the current marketplace. The additional $50,000 in value is not included in the new growth calculation, even though it increases the total valuation of the community's tax base. In addition, the factor is not adjusted for decreases in the tax base due to demolition, fire, or other reasons. It is based on increases only. Since the new growth factor is based on a comparison of last year and this year's assessed valuations, it is calculated after the assessors have set all values for the year just before the annual tax rate is set. At that time, it is reported to the Department of Revenue as part of the tax rate setting process.
Okay. Thank you, Mia. New growth. Any questions on new growth?
Yes, sir.
Third category of new growth. You had, the example was a college sold off a parcel of land to be developed,
Mhm.
and that increased new growth.
Mhm.
If private residence were sold to a non-taxable entity, let's say a church.
Excuse me, can I just pause you for 1 second? Would you mind just coming up to the
Oh.
podium so that's, your whole question is shared with the group? Thank
All
you.
right. So my question deals with the third category of new growth. We saw that in the example, a college sold a parcel of land to a developer. It increased new growth. Is the contrary going to be true? A private residence is sold to a non-taxable entity, let's say a church. It comes off this tax rolls. Does new growth go down by the amount of its assessed value?
Thank you for the question. It does not. It reduces the town's total valuation by whatever the value of the property was that now is exempt, but it doesn't impact growth. Growth cannot be negative, otherwise it's not growth.
Even though it's smaller.
Right.
And new growth is a calculation done annually based on the construction done in that fiscal year or calendar year.
Mhm.
So it's a one-time calculation. So it doesn't, the new growth from last year doesn't carry forward to another year. It's a whole new calculation based on the prior years.
If we have a ton of permits in 1 year, let's say, we'll have a ton of new growth. If we have less permits the next year, we'll have less growth. It varies. There's no consistency. Moves from year to year.
My issue is that we had property that was being assessed and taxed, and it transfers, the ownership's conveyed to a non-taxable entity. Why isn't that reflected in new growth?
It's not
it should come
reflected in
down.
new growth. What comes down is the total valuation for the town.
So that is reflected there?
Yes.
Okay. got it.
Absolutely.
All right, good, thanks.
Yeah, Governor Prince.
Yeah.
Anyone else? Yes. Oh,
Can we bring a microphone over to her then? Because it needs to be recorded, not just for this session, but for people who watch it in the future, in case they have the same question.
Yeah, and if you could introduce yourselves too.
Nancy Wren. My question is, just by listening to this video, everybody talks about assessment values and the rise in market value. That's the conversation on the street. Just at this point, they're saying that doesn't affect anything else. So that doesn't affect the new growth. So I would like to know how our new growth is doing in Orleans, and sort of if you could do a little picture of what new growth in Orleans is, if that's not the major thing.
So again, growth is not a consistent thing. In the last 2 years, our growth has been higher than historically, largely due to the amount of work that's being done. That's really, I mean, a lot more property is transferred in the last 2 years in Orleans, so a lot more work, a lot of land is sold. So growth right now is higher than it has been historically.
So on an annual basis, new growth is somewhere usually between $200,000 and $400,000. So this year for FY '23, Brad just received an estimate of around $400,000 that will be available. For planning purposes, we always estimate a minimum of $200,000 in new growth. And at the end of the slides regarding Proposition 2.5 and the levy and the assessments, Brad will walk through the handout that was on the website in Finance 101 that showed how our tax rate was calculated, how the levy limits calculated new growth, and the tax rate. So we'll get to that at the, I think it's the end of slide 8.
Well, I was hoping to give that to them so they could follow along. Because I have a bunch of them here, if anybody wants it, just to see kind of how what they're seeing makes sense.
Do you have it printed, Brett?
Yes, ma'am.
Does anybody want it to follow along in the room?
Sure.
Yeah, let's get
It's
them.
also available on the Finance 101. It was part of the homework for tonight, so you can always print it at a later date.
Great. Okay, we'll keep moving.
We'll just wait till everybody's settled. Right.
Seatbelts on.
Kathy, you have a hand on Zoom, by the way.
Great. And also, when someone asks a question, in addition to announcing who you are, if you can just indicate what committee you're a member of, that would be appreciated. Go right ahead, Mia. You can pull in that question, please.
Lynn, that's you.
You're muted, Lynn.
Okay, just back to a point that Kathy Doan just made, and looking at the fiscal '22 tax rate paperwork, the homework. What this says, the first page of the tax levy, it says Orleans recorded $41,602,000 in new growth value for fiscal '22. So that's a little more than $400,000. So that kind of knocked me sideways when I read it. So maybe there's something that's a disconnect between what we're talking about and what Brad's going to walk us through when we look at this.
Yeah, Lynn, the 41,602,000, that's how much actual assessed value I picked up. That times last year's tax rate gives us our new growth calculation, which was 326,000.
Okay, again, the way that sentence is worded, And I see the calculation, but the way the sentence says Orleans recorded 41 million, et cetera, in new growth value.
Right, you
And
are.
that sort of like, what the heck? And I wrote down in my margin notes, that's $22 million houses, and I'm thinking, that's an awful lot. Okay, thank you.
Michael, did you have a question?
That was the same question.
So we will make sure that gets edited on the Finance 101 to clarify that further. Brad? Thank you. Are there any other questions on Zoom, Mia?
I don't see any more hands, Kathy.
Okay, nothing in the audience, so you can proceed with the next video, please.
The final step in determining the new levy limit for a year is to compare the subtotal that results from increasing last year's levy limit by the annual 2.5% and new growth factors to this year's levy ceiling. As we said previously, the levy ceiling is the maximum amount the levy limit may be in a given fiscal year. It is a constraint on the size of the levy limit. The law sets out this formula for calculating the levy ceiling. The total assessed valuation of the community's taxable real and personal property for the year is multiplied by 2.5%. The levy ceiling is a dynamic figure. That simply means that it changes every year because the valuation of the tax base changes as properties are added to or removed from the tax rolls. In addition, properties are revalued to reflect current market value on a periodic basis. The final step in determining the new levy limit for a year is to compare the subtotal, our preliminary limit, that results from increasing last year's levy limit by the annual 2.5% and new growth factors to the levy ceiling. The levy ceiling is the lesser of the two numbers. The subtotal is the new levy limit for this year, so long as it is below or at most equals the levy ceiling for the year. To illustrate, go back to our example of the basic levy limit calculation. Last year's levy limit was $100 million. That $100 million base is first increased by 2.5%. In this case, that would be $2.5 million. Next, we add the dollar amount allowed as new growth. Let us say for illustration purposes that our new growth factor is $2.5 million. If we add our $100 million prior year levy limit base, plus $2.5 million automatic 2.5% increase, plus $2.5 million new growth factor, we arrive at a subtotal of $105 million. Let us also say for illustration purposes that the assessed valuation of the community this year is $10 billion. Multiplying that amount by 2.5% equals a levy ceiling of $250 million. Clearly, our subtotal of $105 million is below our levy ceiling, and therefore, the community's levy limit is $105 million. If last year's levy limit, as increased by 2.5% and new growth, is more than the levy ceiling for the year, then the ceiling becomes this year's levy limit. Why? As we explained before, the levy limit must fit within the levy ceiling for the year. In the earlier example, if our subtotal had been $265 million instead of $105 million, then the community's levy limit would be $250 million. This highly unusual circumstance is unlikely to affect most communities. The reason is that the total assessed valuation of a community's tax base, and therefore the levy ceiling, generally increases over time at a higher rate than the annual levy limit, and therefore the ceiling increases at more than a sufficient rate to accommodate the two annual increases in the limit. As we have seen, the levy limit establishes the maximum amount of property tax revenues a community will ordinarily have for budgeting purposes each year.
Questions? None in the audience? Any on Zoom?
No hands, Kathy.
Okay, very good. Next, please.
As we have seen, the levy limit establishes the maximum amount of revenue a community will ordinarily have for budget purposes each year. However, Proposition 2.5 allows a community to levy above its levy limit or even above its annual levy ceiling upon voter approval at a referendum election. Referenda questions that allow a community to levy above the limit or ceiling are commonly referred to as overrides. There are actually two different types of referenda questions that allow for a higher levy, however. One, the levy limit override, and two, the exclusion. They are used for different purposes and have different effects on how much a community can levy in the year voted and future years. The decision to place overrides or exclusions before the voters is made by the select board in a town or the city council with mayor's approval if required in a city. Proposition 2.5 also has a referendum type that requires a community to reduce the annual levy limit. That type is called an underride.
Questions on overrides or debt exclusions? So most of our projects in the town of Orleans, our major capital projects, are approved through a debt exclusion vote. So that is outside of the levy limit. The general operating override, which we approved at the May town meeting for the school department, is within the levy limit, so therefore it increases our levy limit. So the difference between the override and exclusion are totally different. Any questions about overrides and exclusions?
This is actually back more toward levy limits, and I'm just curious about historically in Orleans when, excuse me, when you look at the annual calculation of the 2.5% increase plus the new growth, what has that overall percentage amounted to? Does that make it 2 3/4%? 3%?
So again, the levy limit is not what we appropriated as the levy from the prior year. So let me clarify that. Secondly, the levy limit would be increased by the 2.5%. So if add another 200 to 400,000 from new growth, so whatever that equates to.
That's what I'm trying to, is
So-
it less than 3%, do you think?
It is less than 3%, right? Correct, Brad? Or-
Yeah. Doing quick math, yeah, it's less.
It's close to 3%.
Other questions?
Anybody on Zoom, Mia?
No hands.
Okay, great, thank you. You may proceed.
A levy limit override can be defined as a dollar increase in the levy limit approved by the voters. That is, the voters approve a dollar increase in the levy limit established by the law. The levy limit override has 3 distinguishing features. It, 1, is a permanent increase in the levy limit, 2, raises funds for any purpose, and 3, has limits on its amount. First, the levy limit override creates a permanent increase in the levy limit base. The impact is to increase the amount a community can levy for the fiscal year voted and in future years. To illustrate, let us say that our levy limit for this year is $100 million. The voters approve an override of $1 million. The community can now levy $101 million this year. In addition, the base for calculating next year's levy limit will become $101 million rather than $100 million. The reason is, as we said before, the override is an increase in the levy limit itself, and it is the levy limit that is the base for future years' calculations. The second feature of the levy limit override is that it can be used to generate additional funds for any municipal expenditure. It is generally intended and usually used to raise extra funds for annual operating and other recurring costs, however, which is the reason for its permanence. If the municipality wants to provide a certain level of police protection, for example, the costs of doing so are not one-time costs. They will continue into future years. The third and last point about the levy limit override is that it cannot increase the levy limit beyond the levy ceiling. Why? Because the override actually increases the annual levy limit, and that limit always has to fit within the levy ceiling. A levy limit underride is the opposite of an override. It can be defined as a dollar decrease in the levy limit approved by the voters. Therefore, an underride results in a permanent reduction in the levy limit base. It decreases the amount the community can levy in the year voted and in future years. For example, the levy limit for this year is $100 million. If the voters approve an underride of $1 million, the community can only levy $99 million this year. In addition, the base for calculating next year's levy limit is now $99 million rather than $100 million.
Questions? Seeing no questions, nothing out on Zoom. Oh,
You got one on Zoom, Kathy.
okay, go right ahead and bring them in, please.
So Ward,
Yes, thank you. Just to get my video. Anyway, I'll just speak from here. I'm just curious when the last time there was an underride in Orleans.
We did one underride, I think, 1998. And it was a determination by the select board to permanently reduce the amount of unused levy capacity the town had at the time. I think when we did that, there were probably only 3 other communities that we could find a record that had ever done an underride. So that was something, and that, looking back on that, that did create problems for the town and the ability to fund operations going forward. But again, it was a policy decision made by the board at the time.
The follow-up would be, I think you sort of answered it. Did it have a rebound effect? I mean, sometimes when you make a move like that, then you have to go to the other extreme or the
Yeah, I had done I think I look back since 1996, I think we've done 14, if I recall, 14 general overrides. And probably the ones earlier on, as I said, we did one in 1998, the underride. I think some of those overrides were a direct result, because I think the underride was somewhere in the neighborhood of $300,000. So that certainly impacted our ability to live within the 2.5% increase each year. And we probably had some overrides as a result of that.
Thank you.
Michael, did you have a question?
No, just let it work.
Let's go.
Anyone, any further questions, Mia?
I don't see any hands.
Okay, perfect. You may proceed.
Excess levy capacity is simply the difference between the community's actual levy and its levy limit. In years where an exclusion applies, it is the difference between the actual levy and the maximum allowable levy. For example, let us say the community has a levy limit of $100 million. If its levy for the year is $98 million, then it has $2 million of excess levy capacity. The community chooses through its budget decisions not to tax at its limit. That tax revenue is gone forever. The community can never levy an additional amount on taxpayers to raise that $2 million of revenue. A community can have excess levy capacity in one year, and in the following year levy up to the full amount of its new levy limit, or maximum allowable levy if exclusions apply. It can levy up to that amount no matter how much the levy increases over last year's levy. In our example, This community had a levy limit of $100 million last year. Let us say that next year's limit is $105 million, based on a $2.5 million automatic increase and another $2.5 million increase due to new growth. Next year, the community can increase its levy all the way from $98 million to $105 million, thereby using the $2 million in excess capacity it saved the previous year. This is accomplished through its budget decisions. No voter or other approval is required. There are three basic differences between an override and an exclusion.
Thanks for pausing that, Mia. So the town right now is at its maximum levy capacity. So that's why, therefore, at the October town meeting, there are going to be some requests for votes for additional override to settle some collective bargaining agreements. So we have very minimal excess levy capacity. I think it's around $68,000 right now. New growth will help increase that excess levy capacity so that we can use that as a funding source for some of the articles at the October town meeting. But right now, it's important to say that we are close to our maximum levy limit. Any questions on the levy?
So,
Just announce yourself,
Tim
please.
Cunahan, I'm on the Finance Committee. So the free cash that we have this year, we could roll that forward and let that go against things like the increases in our operating expenses that we're going to see for the new police and fire contracts, right? Instead of spending it out now, right, we could use that and allow that to get applied to future programs.
The town has a policy that free cash is a one-time revenue source. Therefore, you should never use it for ongoing operating expenses. The collective bargaining contracts are ongoing operating expenses. So if you don't fund it today, you're going to be in a worse position next year, because free cash is not a guarantee.
Right, well, I just see us
so-
being in a worse position because the contracts are obviously higher than 2.5%. So we're going to have overrides for them, right?
That's those are articles in the town meeting warrant for next Monday.
Subject to
Right.
general overrides.
Yes, yeah. Okay, I'm just wondering,
Tim, if we could stay general just to get through the information
Okay,
rather than debate
I'll write a
budget
separate
philosophy,
question.
that would be great. Only because we have to stop at 6 o'clock.
Are there any further questions? Okay, thank you. Anything on Zoom, Mia? Okay, great, thank you. Okay, you may proceed.
There are three basic differences between an override and an exclusion. The first relates to their purposes. An override may be used to raise the levy to cover spending for any purpose. An exclusion may be used to raise monies only for capital spending. The second difference relates to their impact on the current and future year's levies. An override permanently increases the levy limit and permits an increase in the levy of the year voted and the levies of future years. An exclusion just temporarily increases the amount the community may levy. A debt exclusion lasts only for the life of the related borrowing. A capital expenditure exclusion lasts only 1 year. The third and final difference relates to limitations on the amount the levy may be increased. An override cannot result in a levy limit and therefore a levy above the levy ceiling. An exclusion, however, can result in a levy above the levy ceiling. There are no limitations on the number or dollar amount of exclusions that may apply in any year. The first step is to determine the community's levy limit for the year, since it establishes the maximum amount the community can levy in the ordinary course. The basic calculation for determining the levy limit is to increase the previous year's levy limit by 2.5% and new growth. This subtotal is compared to the levy ceiling for the year and is the new levy limit as long as it is within that ceiling. Next, we would look to see if any referenda impacting the annual levy limit had been voted. We would increase the levy limit by any override approved for the fiscal year. This new preliminary limit must also be compared to and be within the levy ceiling. If an underride has been approved, we would decrease the limit by that amount. The last step is to add any exclusions that apply for this fiscal year. This total may exceed the levy ceiling. The final amount is referred to as the maximum allowable levy. A community cannot levy more than that amount for the year and must set its tax rate within that amount to be in compliance with Proposition 2.5.
Questions? On Zoom, anybody?
No?
Great, so that wraps up the Proposition 2.5 and the levy discussion, so we'll move on to debt at this point. Please proceed.
We have a 5-minute video and we have 6 minutes to fit it in. I wanted to gab for a while afterward, but let's watch the video. I had some questions from the FinCom to address. I don't think we're going to be able to get to those. But we'll expand on this in our next session.
Go ahead, Mia.
Welcome. This presentation will provide an overview on municipal debt and how Massachusetts cities and towns can issue it. Please note that additional requirements may exist for regional school districts and special purpose districts seeking to issue debt. Municipal debt is debt, ordinarily notes or bonds, issued by cities and towns to lenders in exchange for funds, so that the city or town can fund certain governmental obligations. Debt may be issued to fund the acquisition of capital assets or to undertake a capital project. For example, debt can be used to finance the purchase of a fire truck, school and other municipal facility construction, construction or extraordinary repair of municipal infrastructure, including streets and water and sewer systems, building of a park or playground, or the purchase of land. Cities and towns generally pledge their full faith and credit when borrowing. In some cases, municipalities can pledge a specific revenue stream in order to secure the debt with the lender. Interest on municipal debt is often tax exempt, providing an incentive for investors. In order to maintain this exemption, the debt must be properly authorized and issued for a governmental purpose. Cities and towns in Massachusetts may only borrow as permitted by the legislature through the general laws or a special act. There are laws in place that govern what municipalities can borrow for and for how long, how they can pay off the debt, and how much debt they are able to authorize and borrow. This table references the statutes that govern specific types of projects municipalities may borrow for. The maximum amount of debt a city or town may have authorized at any time is 5% of its equalized valuation, which is the full and fair cash value of property within the community as biannually determined by the Commissioner of Revenue. However, there are a number of project types that fall outside of the statutory limit. For example, borrowing beyond the 5% limit can be permitted for constructing sewer systems, improving a public airport, or for emergency appropriations approved by DLS's Director of Accounts. For a listing of such projects, please refer to DLS's Asset Useful Life Schedules and Maximum Borrowing Terms Guidelines, which are available online. The guidelines define the maximum borrowing term for each type of asset or project. Borrowings for these types of projects are excluded from the limit and are known as outside debt. Borrowing for projects that apply towards the statutory debt limit are referred to as inside debt. A municipality may authorize debt in an amount equal to 10% of its equalized valuation with approval from the Municipal Finance Oversight Board. This table shows the state statutes that govern municipal borrowing limits, purposes, and terms. Debt issuance must be authorized by a 2/3 vote of the local legislative body, which is the city or town council or town meeting. In a city, the mayor may also need to approve of the issuance. In a town meeting form of government, borrowing can be approved contingent upon the approval of a Proposition 2.5 debt exclusion. A vote to do so does not place the exclusion question on the ballot. The decision to present any Proposition 2.5 question to the voters is still made by the Select Board, and the borrowing authorization is not effective until the exclusion passes. There are multiple individuals who play a role in the debt issuance process. The local treasurer prepares and issues the bonds or notes, which are typically countersigned by the mayor in a city and by a majority of the Select Board in town. Municipalities also hire financial advisors to help decide which type debt instrument to issue, prepare issuing documents, communicate with rating agencies, and provide other guidance. A community's bond council will ensure that all legal prerequisites for issuance have been fulfilled, prepare town meeting warrants and other notices, confirm the tax-exempt status of debt, ensure all charter requirements and bylaws are followed, and confirm that all necessary approvals from state agencies are received. The three largest rating agencies are Moody's Investor Service, Standard & Poor's, and Fitch Ratings. The rating agency's function is to render an opinion on the municipality's likelihood of default. In conducting an assessment, the rating agency will analyze financial statements, management capability, fiscal stability, economic condition, and other data. The agency will then issue a report that presents the rating assignment and describes the community's financial position. Purchasers of municipal bonds and notes use this rating when considering their bids. Typically, higher rated communities garner lower interest rate charges.
So my goal here would be to explain some of this in a little more user-friendly description, but I will close in saying that the videos available at the Division of Local Services, there's over 100 of them on a variety of topics. You should view them. They've been up for about 2 years. There's 351 communities in Massachusetts, and I'd like to think that at least one person from every town watched a video once. There have been about 200 views per video, so please view them. They're a great learning tool. That's why they're there. I'd like to continue this at Finance 102.
Could you just indicate, so we have achieved the highest credit rating for a municipality. So we because of our management structure, our policies, and our financial results, we are a AAA credit. We've received a AAA rating, and we continue to maintain that, which provides us the opportunity to borrow money at the lowest interest rate available for a municipality. Scott, can you just, before you close, can you indicate where we stand in terms of the EQV? It's in the handout.
Yeah, so they talked about equalized value here, and I guess the best way to look at that is, when you go to purchase a house, they tell you they'll loan you 80% of the value of the property, 80% loan to value. That calculation they showed is similar to that, which is the reason they do not include the cost of paying the debt service in that figure. Now, they use a loan-to-value ratio of 5%. It's far more conservative than they will loan you or I, but that's just the start. That's what we call the debt limit, and much like levy limit, levy ceiling, there are adjustments made to that number to bring it down to what is known as the borrowing capacity, which is a lower, different number. We'll have to get into that at another point.
So our borrowing capacity at that 5% level is $243 million.
That's your debt limit.
Debt limit.
Not your borrowing capacity, but that is the measuring point they start with.
Okay, so where do we fall within that?
We're at about 1%. Statewide, we're somewhere in the middle of the pack vis-a-vis other communities.
So
That's
we're
not
at
an or- that's not
1% of our total EQV
Right.
allowable amount.
If you sold all of the property in town, nobody paid their taxes, we took everyone's property, we sold it all, that's the equalized value.
Or Scott, would another way be saying that we can borrow up to 5% of the EQV, but we're at 1% now, closer to 1% in terms of our community?
You could, but you wouldn't want to, but the state says you could, but there are adjustments made to that figure for debt that's been authorized that we haven't yet issued that brings that number down a bit. Contingent liabilities, if you will.
I apologize. This is, you can see we need more than an hour, which I'm grateful for that there are questions, because this is a new endeavor, and the idea is to get us all prepared to go into what are the tools that we can use, and are we all using the same vocabulary and understand to coalesce around really long-term planning for our community in a different, more collaborative way. We might be able to, if there's demand in the room, 102 was going to happen sometime in December. We might need to speed that up in order to finish some of these before we begin our budget process mid-January. That was the goal. Do you want to continue on with the, I know we have people standing by at 6 o'clock.
Yes, so if in attendance, if you haven't signed the attendance sheet at the front, please do so you obtain proper credit. Also, for those who could not participate today or via Zoom today, this will be posted, as Andrea indicated earlier on, it will be posted in the Finance 101 link on our website. And to receive credit for watching this training in its entirety, please send an email to the Select Board's office at the email address shown on the screen, and in the subject line, please include the phrase Proposition 2.5. Thank you.
You only need to worry about attendance if you're on one of the required committees. You will know if you were. If you aren't, thank you for joining us for the conversation, the first part of it. Cool. All right.
Great.